Yes. So, welcome back after the break. So, shall we start now? I hope you have taken the right amount of a break. You have revised it, each and everything. Now, we shall be moving ahead with the new section, that is the section number 50, which talks about that special provision for capital gains for transfer of a depreciable asset. See, if some asset is in the block, okay, that we have already understood that there is a block of an asset. Yes, if there is an asset which is in the block, then when we are selling that asset is going to be a short term capital gain. Always remember, when the asset is kept in the block, whenever it is used in the block, then it is a depreciable asset. We are depreciating it, and whenever the depreciable asset is sold out, it is always and always a short term capital gain, not a long term capital gain. But I need to explain you something. So for that explanation na, I just want you to write something. Write with me. It is important that this particular section to be written. So I am also going to write this particular section. You should also going to write this particular section. Okay. Now, section number 50A. Now, listen to me very carefully. Usually, if you hold if you hold an asset for a long period, for a long period, that is example for more than 24 months, for more than 24 months, okay, the profit is treated as capital gains, okay, as capital gains, which is what, long term capital gains, it which is what, long term capital gains that you hold for more than 24 months, then it is a long term capital gain. But but for section number 50, section number 50, sorry, not 50, sorry, not 50A, it is 50. For section number 50, just for section 50 is a special provision that overrides this general rule. Okay, section number 50 is a special provision which overrides this particular general rule. Which rule? The rule which is given in the capital gain chapter, which says that if you are holding particular asset for more than 24 months, then it is going to be treated as a long term capital gain when you sold that particular asset. Okay, this is the rule. Now, what section number 50A says, 50 is, again and again I'm saying 50A, but section number 50, what it says that if a capital asset forms part of a block of asset, parts of a block of asset on which depreciation has been allowed, any capital gain, arising from the transfer is deemed to be short term capital gain, is deemed to be short term capital gain, that is STCG, regardless of the how long the asset was held. Okay, we do not care for the purpose of the block of asset, for the purpose of the block of asset, whatever the asset is in the block, we are charging the depreciation on it. And whenever a depreciable asset is sold, so it is always a short term capital gain. We are not going to see for how long you have hold that particular asset, whether if you have hold it for more than 24 months, more than 36 months, we does not care. We'll not say that it is a long term capital gain. No, it is always and always going to be a short term capital gains. Understood? First of all, whether you understood this particular thing or not. Usually, the general law under the capital gains is that if that particular asset, if you hold it for more than 12 months, 24 months, 36 months, based on the criteria, we'll understand in the capital gains chapter. But if you hold for more than this particular period, then it is going to be the long term capital gain, and you have to pay the taxes which is applicable and taxes on the rate which is applicable as per the long term capital gains. But for the depreciable asset on which the depreciation is applied, because it is in the block of the asset, it is always and always be a short term capital gain. It can never be a long term capital gain. Understood? Now, how we should compute the capital gain under section number 50, whether it is short term or long term. See, long term capital gain is not talked about in section number 50. Why? Because it is only dealing with the asset which is depreciable asset, and whenever it is a depreciable asset, it is always and always going to be a short term capital gain. So we are not talking about the long term capital gain under section number 50. We will see that how the long term capital gain will be computed under the capital gains. But here, for the purpose of section number 50, what is our priority? Our priority is to compute the short term capital gain under section number 50 on which asset which is a depreciable asset. Okay, now listen to me very carefully. What it says: capital gains under section number 50 are computed generally in two specific situations. In two specific situations. Situation A: what is the situation A? Where the sale consideration exceeds the value of the block. That is, you have a surplus, which means whatever the value of the block, you are getting the sale consideration which is in excess of the block. That means you are getting the more value. So this happens right here. This happens when you sell one or more asset, one or more asset from the block. Okay, and the money you receive is more than more than the total cost available in that block. Okay, then only it is going to be the surplus. What it says that this happens when you sell one or more asset. Are you selling only one or more asset? You are not solding out the whole block of the asset. No, only selling few assets from the block. The block is still there. Okay, and the money that you are receiving is greater than the cost available in that particular block. That is, the WDV of the block is lower and you are getting the more amount, then only this particular surplus will come. Okay, this means the block is, let me change the color of the pen because it is important, right now. What color I should take? What color I should take? Let me write it from the pen. The block still exists physically, but value becomes negative mathematically. What it says that in this particular case what is happening, that block is still existing physically. Why it is existing physically? Because you are not selling the whole block, you are just selling out the one or more asset, you are not selling out the whole asset. So that is means some assets are there, that is why the block is still remaining. But there could be a case that the value becomes negative. Why the value becomes negative? Because the WDV is supposed 10,000 rupees and you are selling it is in 20,000 rupees, so you'll get the 10,000 in excess. This is what a negative value. This is what a negative value. Okay, so the value becomes mathematically negative. So how to compute? Now the question is how to compute, how to calculate or compute. Now it says that very easily, very easy. It says that if your full value of consideration, that is the sale price that you are receiving, the full value of consideration is more than is more than the aggregate of, first thing, expenditure incurred in relation to transfer. Second point, opening WDV of the block. Third point, actual cost of any of the new asset acquired during previous year. So what you have to do, you have to take out the opening WDV plus any actual cost of the asset that is you have acquired in this particular year. So take all those things. Okay, opening plus purchases. If you have done any expenditure in the case of transfer, so you have to reduce it as well. So take the aggregate of it, all these things to be aggregated first, and see whether this aggregated as well is lower than the full value of consideration. Means the full value of consideration is even higher than the aggregate of these three things, then it is going to be your short term capital gain. So the excess, so the excess shall be short term capital gain. So do you understand how to calculate the short term capital gain? First you will see the sale price. Okay, see the sale price. If I put it in this way, that is sale price minus the expenses done on the transfer minus my opening WDV minus my purchases. So whether I'll get the profit, this particular profit is what the short term capital gain. This particular profit is what the short term capital gain, because aggregate of this is even lower than the selling price. That is why the difference we are getting now is what short term capital gain. Understood? Very logically, very logical. You also, if you also calculate the long short term capital gain, if you also calculate it on the normal mathematical way as well, this is only going to be the profit, because in the from the selling price you remove all the expenses, you remove what is the cost of my asset that I have sold, so balance is the profit. So the cost of the asset that you have sold is the opening WDV plus the purchases that you have made during the year, and the expenses while transferring is done. So the balance amount which is left is the profit. This is what you have done. Nothing new in this particular formula. They have given the formula, but nothing new in that. This is you are doing from the very childhood age. The normal calculation of profit is done by this method only. Understood? So this was the situation number one. That is, we have covered where the sale consideration exceeds the value of the block. This is the first case. Now, shall I move to the second case? Tell me that. Shall I move to the second case? Situation B. Second case is important. Listen to me very carefully now. Okay, the block, or right, light, let me write it from black. Na, yes, the block ceases to exist. Now there is no block exist. In the earlier part, we have said that we are just sold one few assets from the block, but not all the assets. But now in situation B, we will say that we will transferring all the assets from the block. Now what will happen? Listen to me very carefully now. In this case, yes. Now listen to me. This happens when all the assets in a specific block are transferred during the previous year. When the all the blocks are sold from the block during the previous year, then the situation number B arises. Now how to compute here as well? How to compute? It is also a short term capital gain, but how we will compute it? This is that you compare the sale value with the total cost, with the total cost. And what is the total cost? Total cost is what? Opening WDV plus cost of new assets, okay, plus transfer expenses. Same way what we have done in the earlier part, we are doing the same. Yes, now understand, now listen to me very carefully. They are saying that the sale value, SV is the sale value, okay. Sale value is greater than the cost. uh, Sale value is greater than the cost. If this is the situation, then the difference is short term capital gain. Short term capital gain, logical. If the sale value is greater than the cost, then it is going to be the gain. But now the sale value is less than the cost, means the cost. What is the cost? Cost is this, the whole amount, which is greater than that. Then the difference is going to be the short term capital loss. Is going to be the short term capital loss. Logical. But listen to me very carefully. In situation number B, the short term capital loss can come, but whether in situation number A, whether the short term capital loss can ever come? No. It is always and always be what? Short term capital gain. But under situation number V, when we sold all the assets, the short term capital loss can also arise. First tell me this particular thing. Is this point clear? Now we have to understand it. Now we have to understand it. I am giving you a final version. I am giving you a final chart. Okay. Summarize each and everything. I am giving you the final chart. Okay. Just a second. This, this scenario, condition, and what is the result? Okay. Now, first scenario is what? Surplus scenario. We have seen the surplus where the value, that is the sale value, is exceeding the cost. Whenever the sale value is exceeding the cost, in the case of surplus, that is situation A. In situation A, okay. So whatever the difference is na, is short term capital gain, is always be a short term capital gain. Now in point number B, that is a deficit. That is a deficit, means the block continues. the block continues, the block does not cease to exist. The block does not cease to exist. There as well, the sale value is less than the cost. There as well, the loss, the sale value is less than the cost. That is, the cost is higher than the sale value, and block still has the asset, and block has the assets. In that particular case, it can never be a short term capital loss. Now I have already said you, now I have already said you, in this particular case it is always and always be a short term capital gain. It can never be a short term capital loss. But here as well, the cost is increasing, so my loss is there. My loss is there because the cost is increased, but I cannot say it is a loss. I cannot say it is a loss. It is said that the difference, listen to me very carefully now. The difference becomes what? Closing WDV. The difference becomes the closing WDV of the block. Okay, of the block. Whatever it is going to be the closing WDV of the block. No capital gain, no capital loss. Depreciation continues on the block. Now you can claim the depreciation as it is. You can keep going on and claim the depreciation because the block is still there. If there is a block, then you have to claim the depreciation as usual. So whatever the value it is, the difference is going to be the closing WDV, and you can claim the depreciation as it is. Okay, now the point number 3. What the point number 3 is, what block is empty. Block is empty, that is cease to exist. Block is empty, that is cease to exist. So here as well, if the selling price is less than the cost, if the selling price is less than the cost, and block cease to exist, and the block cease to exist, here the difference is what? The block cease to exist. In this particular case, whatever the difference is na, whatever the difference is going to be the short term capital loss. So do you understand the difference between the point number 2 and point number 3? See, point number 1 is very usual, you always understand it. But whether do you got the difference between these two examples, point number 2 and point number 3? Whenever there is existing, whenever, see, the cost is higher and the sale value is lower, see, you say that it is going to be the loss. But see whether the block is existing. If the block is existing, then it is not a short term capital loss, it is going to be the closing WDV, and you can claim depreciation as usual. But the block ceases to exist, then in their particular case it is going to be the short term capital loss, because now you cannot claim the depreciation. This is the final summary of what we have already studied till now. Understood? Understood. This is the final summary. Now we have to come and we see what it is written. When a few assets are sold out from the block and the sale consideration exceeds the WDV, when the block is sold and the consideration may or may not exceed the WDV, then the short-term capital gain or loss may arise. Now, the WDV of the block is computed on the 31st March of the previous year, that is on the last day of the previous year, and not on the daily basis. And in case of the stamp duty that is exceeding the sale consideration, then stamp duty is going to be the full value of consideration, that we need to understand. What it says that, see, if there is a stamp duty value, you know that for every property there is a stamp duty value. If the stamp duty value is exceeding the sale consideration, it's exceeding the sale consideration, so the stamp duty value shall be the selling price. We'll assume the stamp duty value as the selling price, not your sale consideration. So whatever the sale consideration, we have to compare it with the stamp duty value. If the stamp duty value is higher than the sale consideration, that means you have sold it in loss, because the government is saying that the property values at the stamp duty value now, and you are selling it below that, then it is not allowed. Then they'll say that the stamp duty value is going to be the full value of consideration. We'll assume that stamp duty value is going to be your selling price. We do not care whether you have sold it less or not. Okay, if you have sold it for the higher than the stamp duty value, then the government will take the sale consideration as a full value of consideration. But if you have sold for less than stamp duty value, then the government will take the selling price as what? Stamp duty value. Minimum the stamp duty value should be recovered by selling it. Okay, so see what they are saying, that if only one or more assets are sold, so there will always and always be a short term capital gain. But for which the block and for which the block ceases to exist. That means all the assets are sold. So it could be short term capital gain or short term capital loss. Both the things can be there. The both the things could be there. Listen to me. See, short term capital gain, short term capital loss, both can be happened. Okay, the same is this. Again, full value of consideration minus opening WDV, actual cost or expenses on transfer. We have seen this. This is what we are going to discuss. Okay, so section number 50 we just discussed what is section number 50 is. Section number 50 usually what it says, whether it is a long term capital asset, but you hold it for long term period, we do not care. If it is a depreciable asset, it is going to be short term capital gain or loss. We cannot say it is a long term capital loss. This is what majorly section number 50 says. That finally, if you remember this particular chart, then it is all, it is going to be over. What is the cost? The cost includes these three items. The cost includes these three items. Okay, these three items are included in the cost. This is all. Whether it is very much clear to you, tell me that. It is clear. Shall I move forward now? Shall I move forward? Moving forward to a new section, that is section number 33 AB. Coming to the section number 33 AB, which is very important section. Okay. Usually the question does not come from this particular section, but it is very much important. Why it is important? Because ICA can ask you a random MCQ on this particular topic, and if you haven't studied this topic, then it is going to be very tough for you. So listen to this particular section very carefully. This section is applicable for the assessees who are engaged in the business of growing, manufacturing what tea, coffee, and rubber, not other assessees. Who only to those assessees who are engaged in the business of growing and manufacturing. Listen to me. Not only growing, not only manufacturing, growing and manufacturing both should be there. Not only growing, not only manufacturing, growing and manufacturing simultaneously should be there. So assessee should engage in the business of growing as well as manufacturing what? Tea, coffee or rubber. We do not care about any other third, any other fourth business. Only tea, coffee or rubber. And where? That too in India. There are certain conditions to it. Remember it. The assessee must be engaged in the business of growing and manufacturing, not simultaneous, not separately only growing, not separately only manufacturing. Growing plus manufacturing should be there, and tea, coffee, rubber only, and that too in India. Then only come under section number 33 AB. Otherwise, do not come under section number 33 AB. Understood? First point is clear to you. Yes. Now, what they have to do? If they want to take the deduction, if they want to take the deduction, because section number 33 AB says that if you want to take the deduction, then come under section number 33 AB. Now what is the deduction? Under section number 33 AB, they have said that in order to claim the deduction, you have to deposit any amount. You have to deposit any amount with NABARD. That is a scheme that is approved by a center, approved by the T board or the rubber board. Whatever the T board or the rubber board approve, you have to deposit that amount with the NABARD, or in any deposit amount account which is open for the scheme framed by the tea board or the coffee board or the rubber board with previous approval to the central government. That means whether it is a NABARD, whether it is any deposit amount, you have to deposit the amount there. You have to deposit any amount there. Okay. Now, when you have to deposit it, earlier of what is the amount? 6 months from the end of the previous year. Your previous year is ending on 31st March 2026. Within this 6 months, that is 30th of September 2026, first first date is done. Second is what? Due date of filing of return under section number 139 1. Okay, so if it is a company, and doing the business, so the tax audit applies to it. So for the tax audit company, the due date of filing of return, you don't know, let me tell you, it is what? 31st of October 2026. it is 31st of October 2026. So whichever is lower is always and always be what? 30th September 2026. So by this time period, therefore the date will be 30th September of the relevant assessment year. Okay, your assessment year is 26 27 na. So for the assessment year, that is 30th November, 30th September is always going to be the time limit to which you have to deposit the amount in NABARD and the deposit account, any of them. Okay, either deposit with NABARD or in any deposit account. Understood? So point number 1 done, 2 done, 3 done. Who you are? You are a assessee which is engaged in the business of growing and manufacturing. Not only growing, not only manufacturing, but both growing and manufacturing. What? Tea, coffee, rubber. That too in India. Okay, and you have to deposit what? Any amount with the NABARD or the deposit account. Okay, now till when you have to deposit it? See, as for the simplicity, I can say by 30th of November, 30th of September, but no, you have to remember the whole due date. You have to remember the whole law. What it says? It says earlier of 6 months from the end of the previous year, or due date of filing of return. Okay, whichever is earlier. So the date finally comes is what? 30th of September. Okay, now if you say that I have deposited it, the government will agree that you have deposited it. Eh, Someone can lie as well, na, whether you have deposited or not. Do we get to know? So for that you have to take a report from a chartered accountant. Accounts must be audited by what? By whom? Chartered accountants, and the audit report must be submitted 1 month before the 1 month 1 month prior to the due date of filing of return of income. So the return of income to be filed by what date? 30th of October. So 1 month before is what? 30th of September 2026. By that day only, that is the last thing. If you say this is the last day till when you have to deposit it, so you have, by that time period only, you have to take the certificate from the chartered accountant that your accounts are audited, take the audited financials, and you have to upload it. That means you have to do what? Tax audit. Accounts must be audited. That means the tax audit should be done. Tax audit should be done, and the 30th of September is the tax audit due date as well. Okay, now what is the quantum of deductions? What is the quantum of deduction? We have seen that this particular section is for the deduction. We have seen that I am the assessee, okay, doing the business of growing and manufacturing the rubber, coffee, or tea. Okay, that too in India. I have even deposited it. Okay, within the time limit, I have deposited the amount. Okay, I have also done that. I have also done the accounts audited by the chartered accountant. Okay, and that too before the submission of return of income. Very good. Now, by doing all these things, what will I get? You will get the deduction of what amount? This is the lower of. You will get the lower of amount that you have deposited, or 40% of the profit of such business before deduction. If you want to claim this particular deduction now, so before deduction, whatever the amount of profit it is now, take 40% of it, or the amount which you have deposited it, whichever is lower is going to be your deduction. So lower of amount deposited, or 40% of the profit, which is going to be lower, is going to be your deduction. Now, withdrawal of deposit. I have deposited something. Now, see, in the point number 2, I have deposited the amount. Whether I can never withdraw it. Yes, you can withdraw it. But listen to me very carefully. If you withdraw on the closure of the business or the dissolution of the business, then it is going to be taxable under the head PGBP when in the year of withdrawal. But if you withdraw at the time of death, partition, liquidation, death, partition, liquidation, then it is going to be not taxable. Then it is going to be not taxable. Otherwise, it is going to be taxable. Okay, then there is a problem. Suppose I have withdrawn on the death of an assessee. Okay. Now, with whatever I have withdrawn, I can use it anywhere. I can use it anywhere. No, there is a restriction. There is a restriction in point number 7. Whatever amount you have withdrawn, you cannot use it anywhere. We will suggest you where you can use it. We will suggest you where you can use it. Otherwise, what? Otherwise, if you deviate from the things which I am saying, that where you can use this amount which you have withdrawn from the deposit, if you deviate from these things, then these are going to be taxable as per the PGBP. So if you want to make it exempt, so use as we are saying. Okay, now see, in the deemed PGBP part, what they are saying, that see, where any deposited amount with NABARD or deposit account is utilized for the purchase of what? Machinery or plant to be installed in office premises or the residential accommodation, any office appliances, machinery or plant of which 100% cost is allowed as deduction in one previous year. Don't you think all these 3 points we have seen in additional depreciation, are these 3 points are same like that additional depreciation? So on these 3 point, additional depreciation was also not allowed. They are saying that please do not do all these things, otherwise we'll take the tax on it, we'll assume it as PGP. Earlier we have allowed you the deduction, now we will allow you the deduction, okay, but please do not use for these purposes. If you are using the amount withdrawn for these purposes, we are going to make it taxable for you. But here for the office appliances, the computers are not taken here. Okay, for that purpose, what does it mean? If you buy the computer from the amount withdrawn from the deposit, is it allowed? Yes, it is allowed. It shall not be added to your PGBP income. It is not a violation. It is not a violation. Now what it says, that in last point, which is different point, what it says, if any new plant or machinery installed in a industrial undertaking in business of construction, manufacture or thing that is specified in 11th schedule, that is beer, tobacco. So if you are purchasing any plant and machinery, okay, which is installed in the industrial undertaking and doing what? Manufacturing of beer, tobacco, so we are not going to allow these kind of a machinery, because what is your work? Your work is for tea, coffee and rubber now only. So please do the work for the tea, coffee and rubber. Don't do these beer, tobacco kind of a things. Understood? Whether all the four things understood, if you do any of these kind of a work, then it is going to be your deemed PGBP income, and it is going to be your added in your profits, and we are going to tax it. Whether it is clear to you? Now, such misutilized amount shall be deemed to be the profits and gains of the previous year. If you use this amount in under point number 4, any of the point number 4, then it is going to be your PGBP income. Clear? Now, point number 2, what it says, such withdrawn amount remains unutilized in the previous year. Suppose you have withdrawn 50 crore rupees, but you utilized only rupees 40 crore rupees in this particular year. That means the 10 crore rupees is still unutilized. You have not utilized this 10 crore rupees in the previous year. Then this particular 10 crore rupees also is going to be taxable as PGBP. Then this balance 10 crore rupees is going to be taxable in the PGP. So whenever you withdraw the amount, utilize in the same previous year. If it is not utilized, then it is going to be taxable. Okay, now in which it was withdrawn. Amount not utilized shall be deemed PGBP of the previous year. That is, utilization should be done in the same previous year of withdrawn. Understood? Now what we have said, that if you withdraw any amount and purchase any of the asset from it, okay, we allowed to purchase the asset. Yes, we allowed you to purchase the asset, but the asset should not be transferred within 8 years from the end of the previous year in which it was acquired. Suppose we have acquired the asset in 25-26. So the end of the 26 previous is what? 31st March 2026. So up to the 8 years, 26 to 27, 28, 29, 30, 31, 32, 33, 34. That means up to 31st March 2034, this particular asset which we have acquired in the previous year 25-26, by withdrawing the amount from the deposit, you cannot sell it. After that you can sell it, no issues, but before that you cannot sell it. If you are selling it, then so they said that, see, where the asset acquired as per the scheme is sold or transferred before the expiry of 8 years from the end of the previous year in which it was acquired. My previous is ending on 31st March 2026. After that it is sold. Before that it is sold, then such cost of the asset as it is relatable to deduction under section number 33 AP. That means that particular cost of the asset that you have purchased is going to be the deemed PGBP. The cost of the asset that you have purchased is going to be the deemed PGBP. Understood? Understood. So, whatever the cost of the asset that you have purchased is going to be your deemed PGBP. Now, there is an exception to it. What it says that when an asset is sold to government, local authority, or government company, or such sale with respect to a succession of a firm by a company, then, if sale value exceeds cost, then such excess shall be capital gain. Then such excess shall be capital gain. What it says that if the sale value is exceeding the cost, that you are exceeding the cost, okay, then it is going to be your capital gains. What it says that exception is still here, that if you are selling the asset within 8 years but selling it to government, local authority, company, or such sale with respect to what succession of firm by a company, then it is going to be exempt. It's okay. Okay, but other than these cases, it is going to be or deemed PGBP. Clear? Now, if the sale value is exceeding the cost, then it is going to be capital gain. This is as simple as that. If the sale value is exceeding the cost, it is going to be capital gain. This is a very simple logic. So point number three is also clear. Point number three is simply saying that if you have acquired some asset, okay, I'm just recalling each and everything of the point number three, what it says. If you have acquired any asset from the withdrawal part of the deposit, then it must not be sold within 8 years from the end of the previous year in which the asset was acquired. In our case, it should not be sold within 31st of March 2020, sorry, 2024. But if it is sold before that, then the cost of the asset, whatever the asset that we have acquired, what was the cost of it? The cost of the asset is going to be what? Is going to be my deemed PGBP. Is going to be my deemed PGBP. The asset is sold to a government, local authority, or government company, any company or company where the succession of firm by a company is done. In that particular case, it is going to be exempt, otherwise all going to be taxable. And if the sale value exceeds the cost, then it is going to be taxable as a capital gain. Now, the rule number 8, 7A and 7B. Okay, rule number 8, 7A and 7B. There is an activity. This chart you need to remember. This chart you need to remember. This chart you need to remember. Tell me whether you'll remember this chart with me. Now, what is the work I need to do? I need to do what? Growing and manufacturing. Do you remember this particular word from the first line of this section number 33AB? I need to do what? Growing and manufacturing. Yes. Of what? Tea, coffee, and rubber. Remember in sequence: tea, coffee, rubber. Tea, coffee, rubber. I have to do what? Growing and manufacturing. Okay. Now, 40, 25, 35. Remember, 40, 25, 35. 40, 25, 35. Remember with me. Tea, coffee, rubber. 40, 25, 35. 40, 25, 35. Recalling it. Tea, coffee, rubber. 40, 25, 35. Tea, coffee, rubber. 40, 25, 35. That is what my PGBP income is. That is what my PGBP income is. Like if I am doing a tea business and I am growing and manufacturing the tea, then whatever the earning I am getting, whatever the sale price I am getting, whatever the earning, the profits I am getting, now out of those profit, 40% is my PGBP income, which is going to be taxed, and 60% is the balance, 60% is going to be my agriculture income, which is going to be exempt, which is going to be exempt. Understood? But if I am doing this growing and manufacturing of coffee, then my PGP percentage is going to be 25, and the balance 75% is the agriculture income, which is going to be exempt. And for the rubber, 35% is the PGP, and balance 65 is going to be what? Agriculture income, which is going to be exempt. So only this 40%, this 25% and 35% is going to be taxed. Balance is what? My agriculture income. Understood? Because you are doing the two things: growing and manufacturing. So growing part is going to be exempt. So they are saying that, see, if you are doing the tea business now, so the agriculture income, as per our trend, we know that 60% is the agriculture income, and the balance is from manufacturing, packaging, selling, all these things is about 40% of the work, is only about 40% of the work. Then this 40% is going to be your PGBP income. Otherwise everything 60% is going to be your agriculture income, 40% is going to be your PGBP income. Same way for the coffee, we assume that agriculture income is greater than that, so it is 75%. And for the coffee, in the coffee business, the PGP income is only 25%. Also understood this. And for the rubber, it is 35%, that is a PGP. So whatever the income that you will compute, we'll see the steps to solve the questions. By seeing the steps to solve the question, we'll first understand it. The tea business is 40%. Okay, so whatever the income we are computing now, see, whatever the income we will compute now, whatever the income we will compute, based on then 40% of the above is going to be the my business income, and the balance is going to be exempt income, which is not going to be taxable. Out of the business income, we'll take the brought forward losses, if any, and the final is going to be taxable. That means out of the total income, 60% is going to be exempt in the case of what? In the case of tea. But if it is a case of rubber or a coffee, then it should be 25% or the 35% as all. Okay, so do you remember the rates? Tea, coffee, rubber, 40, 25, 35. Tea, coffee, rubber, 40, 25, 35. Okay, and balance is what? Your agriculture income. But in the coffee na, not in tea, not in rubber, but in coffee, there could also be a part which is a grounding and roasting. In coffee, there could be additional process on the coffee, which is a roasting and grounding, can also be done. If the roasting and grounding, this particular process is also applied on your coffee business, then the PGBP income will increase. Why? Because these two kind of a business, these two kind of a thing is a part of a business income. It is not an agriculture income, because to produce the coffee beans, the roasting and grounding is not necessary. Okay, it is the thing which is necessary to sell the particular coffee. Okay, so you are doing the major part of the coffee business in a you are doing the part of a business. Okay, roasting and grounding is a part of a business. So the major component, the component was increased from 25% to 40% of the PGBP, because you are not only growing and manufacturing, you are also doing some other activities of a PGBP kind of a thing. Okay, to sell the particular product of your coffee. Okay, that is why the the PGBP percentage is increased to 40%, and the balance is the agriculture income. But the same grounding and roasting is not done on tea and not done on rubber. It is only done on the coffee. That is why it is written for the coffee only. So do you remember? Tea, coffee, rubber, tea, coffee, rubber, 40, 25, 35. And for roasting and grounding also, it is going to be 40, 60. Understood? Very easily completed. By this, section number 33 AB is done. Now, what is the steps to solve the question? First, you will take the net profit as per the books, whatever the books has given. Now you have to do all kind of the adjustment, whatever you will read from section number 29 to 43D. Under section number 29, it says na, do all the adjustment as per section number 30 to 43D to reach the final conclusion. That is, we have reached the final conclusion of the net profit. Now out of that net profit, they have said that we will first reduce the section number 33 AB, because this, to compute this particular section number 33 AB deduction, they have said that what? Lower of first amount deposited, or second what? 40% of profit before section number 33 AB deduction. So first we have to calculate before 33 AB deduction what is the profit. We have calculated the profit. So the profit is this, do 40% of it and compare it with amount deposited. Whichever is lower is going to be the deduction. Take the deduction. Now there are some deemed PGBP points. Yes, if you have not utilized the amount drawn in the previous year, it is a deemed PGBP. Add in your income. If you have misutilized the amount, suppose you have applied the amount in purchasing the office appliances, that was not allowed, add it. Okay, and if you sold it before 8 years, then the cost is going to be added in your PGBP income. Everything is going to be added. Everything is going to be added. Understood? This is where you will get your total income. Out of that total income, to say if it is a tea business, 40% is going to be a business income, rest 60% is going to be your agriculture income. Tell me whether it is clear to you. easy. Section number 33 AB is easy. I am giving you 2 minutes. Just read the whole section number 33 AB, and when we is going to solve the questions, there are two or three questions of the section number 33 AB which are very good. Okay, I'll solve one question and I'll give you one question in homework when we'll do the question answer sessions. Okay, now just read it very carefully first. Yes. So shall we move forward now? Yeah. Now, coming to section number 33 ABA. Simultaneously, usually I am giving you the idea which section is more important, which section is not more important, and section number 33 ABA is not at all important. But we need to understand it, we need to remember it, we need to learn it, because they can even ask a MCQ. But this is the least important section. Okay. Now, earlier in the section number 33 AB, we have seen the deduction for the growing and manufacturing of tea, coffee, rubber. Now they are doing the same thing, because the deduction of petroleum and natural gas. They are now giving the deduction for petroleum and natural gas. It is instead of tea, coffee, rubber. Now for section number 33 ABA, what is the business? Petroleum and natural gas. Now all assesses who is in the business of prospecting or extraction and production of natural gas and petroleum in India. That too in agreement with central government. Now see, doing a tea business, coffee business, or rubber business is very much easy. Everyone can do it. But if you want to extract a natural gas, if you want to do a extraction and production of petroleum, then it is a big business. So you have to take the license because it involves the natural impacts as well. Okay, the natural impact and various other impact on the environment. So you have to take the agreement. We have to take the approval from the central government. Now, the deduction amount is allowed only if some amount is deposited in the SBI. Earlier, it was in the NABARD. Okay, but here it is what? The SBI account, that is a site restoration account, that to up to the end of the previous that to up to the end of the previous year. Earlier what was that? Earlier what was that? They had said that 30th of September, that is lower of 6 months from the end of the previous year, or the date of filing of return, whichever is lower. But here they have said that up to the previous year, up to the end of the previous year, that is 31st of March 2026 itself. There is no time limit of 30th of September. They have simply given 31st of March. Okay, now what is the deduction? They said the deduction shall be allowed before setting off the brought forward losses. Okay, there should not be a before, there should not be set off of brought forward losses due afterwards. Okay, but what is the lower of? Same amount deposited or 20%. Earlier that was 40%. Now here it is what? 20% only. Everything remains same, just a small changes. Okay, the theme is based on 33AB itself. Now there is only a small changes. Now deposit amount shall be utilized for the purpose prescribed by Petroleum and Natural Gas Ministry by the Government of India. They have not said, they have not given you the list. They have said that it should be utilized as per the Petroleum and Natural Gas Ministry, uh, whatever the guidelines they have given. Okay, if you are using apart from those guidelines, then it is going to be deemed PGBP. Now note, deduction under section number 33AB shall not be allowed in computation of income of a partner of a firm or member of AOP BOI if deduction is claimed under this section by the firm or AOP or BOI. What does it says that? I read it again. Deduction under section number 33AB shall not be allowed in computation of income for of whom? Of a partner of a firm or a member of AOP BOI. When? When the deduction is claimed under this section by the AOP BOI. If the deduction of this particular income is claimed by, suppose, if there is a firm engaged in the extraction of petroleum. Okay, they have claimed the deduction in 33ABA. Understood? Now ABA. Now what is done? This firm has transferred the money or the profits to its partner's account. So whether these partners can take the deduction of section number 33 ABA? No. Why will they take the deduction of 33 ABA? Because the firm is doing the business. The firm is doing the business of 33 ABA, not the partners. So the partners cannot take the deduction of 33 ABA. They cannot compute their income as per section number 33 ABA. Understood or not? Tell me that. Same way, if there is a AOP or BOI, they cannot take the deduction. The AOP and BOI can take the deduction, but the members of AOP and BOI cannot take the deduction of 33 ABA, because whoever is doing the business of petroleum or natural gas extraction, then they only can take the deduction, not their members or the partners. Okay, now any amount credited in the special account of the site restoration account by way of interest shall be deemed to be a deposit. Okay, if the interest is coming on a site restoration account and it is accumulating, and on that interest also, this is on that interest also you are getting the interest, then it is deemed to be deposit. That you are depositing that amount means the interest, you are not withdrawing that interest is keep on compounding, so that interest part is also deemed as a deposit. So you can take the interest as a deposit and take the deduction accordingly. Okay, and rest all the points are going to be same as per section number 33 AB. Okay, rest all the points, that is what is deemed PGPP and all these things, like not cannot be sold before 8 years, and all these points are going to be the same in section number 33 ABA. This is just a residual section. If you have the time, you can read it at the exam point of view, exam time in 1.5 days. If you don't have a time, please do not waste on 33 APA. Understood? Shall I move forward now? Yes. Coming to section number 35. This is a section, very important section. you can see one or two adjustment of this particular section, and it is a very easy section. It is a very easy section. It says that if you are engaged in a scientific research business, either you are engaged in, or you are contributing to some entity, some company which is engaged in scientific research. Suppose, listen to me very carefully, either you are engaged in the scientific research business, okay, or if you are not if you are if the scientific research is not your business, but you are doing some contributions to the scientific research businesses, then you'll get certain deductions to it. Okay, first, this part is what this block is what if you are doing the scientific research business. If you are doing the scientific research business, then what are the things? Okay, then there are certain things like capital expenditure and revenue expenditure. See, section number 35 itself clearly says that we are going to give the capital expenditure deductions as well. 100% deduction will give it to you. Then in that particular case, the capital expenditure deduction will be taken in this section only. Usually the rule says that capital expenditure shall not be allowed under PGBP, but explicitly says section number 35, then it is allowed. Yes. And the same thing whether we have seen in additional depreciation, whether we have seen in section number 33 AB, and whether we have seen the same thing in a different part, like in the actual cost definition, first point the first point of the actual cost, the special cases. Do you remember? Yes, that is the same thing. That 100% of the deduction we are giving on the capital expenditure as well, if it is used for the scientific research. Understood or not? Now, if incurred during the relevant previous year, if the expenses is done in the relevant previous year, whether in the case of a new business or the existing business, whether it is an existing business or you have incorporated the new business and you have done the you have done the expenditure relating to your previous year, then all the expenditure, whether it is capital expenditure or revenue expenditure, are allowed to you, but only land is not allowed. The land expenditures are not allowed. Apart from land, whether it is a building, allowed, whether it is a plant and machinery, allowed, all capexes are allowed. Only the land deduction will not be allowed to you in the section number 35. Only land will not allowed, otherwise everything is going to be allowed. Now, first point is clear. Whether the expenditure is done for the previous year, everything is allowed except land, whether it is a capital expenditure or the previous or the revenue expenditure. Now, if the business is newly commenced, then expenses incurred during the previous year, during the three prior to the date of commencement of the business. What does it mean? See, point number two. Earlier, I am doing the feasibility study, and I am if it is a scientific research. Now, what I am doing, I am just finding the feasibility thing. Okay, whether this particular business will go on or not. I am doing the research work on it. I am doing the research work on it. Okay, I am collaborating with the scientist. I am working with them whether this particular project will work or not. So I've done lot of expenditures on that particular thing. Okay, on feasibility thing, some researches and some lab tests and so many things before commencing my business. Okay, after getting sure that this can work, so I have incorporated a business after 3 years. Suppose after 3 years, 4 years, 5 years, does not matter. Okay, so what it says that if you have done the expenditure previously for your business, okay, now your business is commenced. So whatever the last 3 years expenditure, if you have done for 5 years, we are not caring about it. We are just caring about the last previous 3 years. If for the last previous 3 years you have done any kind of the capex, we are allowing it, but except land. But for the revenue expenditure, they are allowing 100% deduction to it, but certain conditions are there. We are just allowing only salary and material related expenditure, and that to the extent which is approved by the prescribed authority. See, for the current previous year, we are not asking this. We are giving you the full deduction. But for the previous year, which is three previous year before the commencement of the business, we are asking you that for the capital expenditure we will allow it, but for the revenue expenditure, salary and material expenses are only allowed, that to the extent it is prescribed by the authority. Okay, now, due to deduction under section number 31 3514. What is 3514? capital expenditure. Due to the capital expenditure, business loss cannot be computed. If profit is inadequate, then same treatment as of unabsorbed depreciation will be provided. Suppose due to capital expenditure, my profit could be lower because my business is commenced in this particular year itself. So my sale is not that much, but I have been provided the capital expenditure 100% reduction. So my expenditure, the expenditure part will be higher. It will be very high, but my profits are very low. So by this, what it is a loss. There is a situation of loss. So in that particular case, they said that it cannot be computed. We will not say it is a loss. It should be what, like, it should be treated as an unabsorbed depreciation, and you can treat it, you can take this particular loss for the infinite number of years. You can claim this particular loss for the infinite number of years and keep carry forward it. Keep carry forward it. Understood clearly. So this is what I am doing, the business of scientific research. But suppose I am not doing the business of scientific research, but I am contributing to the agency, I am contributing to the industries or the institutions who are doing the scientific research work. So they are saying that contribution based deduction, that is, if I am making a contribution to whom? Notified bodies by the central government, where for use in the scientific research or for use in the social science or a statistical research. Okay, like the census we are doing, not the census. Okay, or maybe the ASI, social sciences, what, the archaeological survey of India. Okay, they are also doing the scientific researches and all. So if I am providing for use of the scientific research or the social science or the statistical research purposes, it is allowed. 100% deduction is allowed to me. I am contributing to a national laboratory, I am contributing to IIT, universities, or any person which is approved by the government, which is approved by the authority. I am allowed to take 100% of those deductions. Okay, or I am providing the contribution to a Indian company whose main objective is the scientific research and development, and it is also approved by a chief commissioner of income tax and is paid for the use of the scientific research, and I have paid this for the scientific research purpose, not for any other purpose. So in that particular case as well, whether it is allowed to you, yes, 100% deduction can be taken care. Okay, now, so if you are providing the contribution to a scientific research institution, done. Social science and the statistical, done. And national laboratory, IIT, university, or any person which are prescribed by the authority, okay, done. To any Indian company whose main objective is what, the scientific research, and it is also approved by the commissioner of income tax, chief commissioner, and you have paid for the scientific research, then you can claim 100% of the deduction that you have contributed. That means in the whole, if you see, in the whole section number 35, you are getting 100% of the deduction whatever you are spending, just except the land. And if you have done that previous 3 years expenditure for the salaries and material, except that, everything is allowed. Okay, salary and material is allowed, but up to a certain limit. Okay, now, point which is important: an assessee shall not be denied the deduction in respect of any sum paid to an institution to which section these applies, merely on the ground that subsequent to the payment of the sum by the assessee, the approval granted to the institution have been withdrawn. What does this point number 1 says? It says that I have given a contribution to, suppose I have given a contribution to a scientific research which is notified by the central government. Yes, I have given the contribution to it, but after giving the contribution to it, after 1 month, suppose this scientific research has done some mischief. So in that particular thing, the central government has withdrawn the notification, that it is now not a notified body. It is now not a notified body. So after withdrawing, see, during the previous year, the approval was withdrawn, but I have already paid the contribution to the scientific research when it was notified. Whenever I made the contribution, it was the notified entity. The notification was not withdrawn by the central government, so my deduction will be given to me. It is not said that the it will not be said that the scientific research association is now not notified by the government, so you will not be given the deduction. No, you will get the deduction. Definitely you will get the deduction, because at the time of making the payment, that was notified by the government. The notification was not withdrawn at that time. Understood? The point number 1 is clear. Now point number 2, for section number 35(1)(1)(a), what it says, that it says that prayer, sorry, payer, it should be a payer, it should not be a prayer, it's a payer, shall be entitled to deduction or of these particular thing only if, that is, a person shall only get the deduction if the donee, means who is receiving the donation, will prepare a statement in form number 10BD and submit to the PDGIT, okay, Principal Director General of Income Tax, okay, up to the 31st March, so 31st May of the next financial year, what it means, like if you are contributing in the financial year 25-26, so in the next financial year, that is 26-27, by 31st of May 2026, they must submit what, they must submit the statement that from where we got the donations. So there should be a statement in form number 10BT that they have to give to what, they have to give to the PDGIT, Principal Director General of Income Tax. Okay, first thing. Then the donee institution furnishes a certificate to the donor, means the person who is receiving the donation will give a certificate to the person who is giving the donation in form number 10BE up to same 31st March of the next financial year. So if a person, if the payer will get the deduction only when the donee do, the person who is receiving the donation will do two things. First, he'll prepare the statement from where he got the deduction, from where he got the donations, and submit it to PDGIT, where the donor will write the payer name and the pen number. Then only the department can verify it. Okay, and the donee, the person will also get a certificate from the donee that yes, we have received this much amount from that particular payer. Okay, up to 31st of March. If these two things are done, then the deduction to the payer is allowed. Otherwise, not allowed. Because the government also want to check now whether you have paid or not. Otherwise, some bogus expenditure, some bogus deductions will be taken in the income tax. So to avoid that particular thing, that no one can take the false deduction, these particular two conditions are put here. Okay, now no depreciation shall be allowed if deduction under section is tax under this section is claimed. We have already seen under additional depreciation. Additional depreciation will not be allowed. I have said that in that particular case, normal depreciation shall also not be allowed. Point number 3 is clear to you now. Everything is interlinked. Yes. If land and building purchased through a composite agreement, if there is a composite agreement, that is in a normal one agreement, land and building both are purchased, but as per section number 35, land deduction are not allowed, then the cost of land and building shall be bifurcated based on the FMV, based on the fair market value, because the cost of the land is not allowed as deduction. Okay, if in the agreement land cost is differently given and the building cost is differently given, so whatever the cost of the building, you can depreciate, you can take the deduction of it, you cannot take the deduction of the land. But suppose you, if you have purchased the land and building at suppose 200 crore rupees, okay, but the bifurcation is not given, so we have to bifurcate based on the FMB, because the cost of the land is not allowed as deduction. Understood? Whether this point is clear to you till now? Point number 4, 3 or 4, whether you need to remember, whether you need to need 1 or 2 minutes to recall the whole section number 35. Want to recall it? Take 1 or 2 minutes. Or just let me make you understand the point number section number 35 to AB as well, because it is related to the scientific research as well. Then we are going to end the class only. We are going to end the class. We'll understand section number 141 3 and all by tomorrow. No issues with that. Okay, we'll start from there tomorrow, and there will be easy sections, very easy sections. Then there is a border thing, 36 37. There will be time, like tomorrow or maybe day after tomorrow we'll be completing this particular thing. Okay, we'll take approximately 2 to 3 lectures more for the concepts only. 3 lectures are like minimum. Now, coming to the deduction for biotechnology business. Coming for the deduction of biotechnology business. Earlier under section number 35, we are doing what? Scientific research business, or we are contributing to the scientific research business. Now, section number 35 to AB says that if you are in the business of biotechnology, if the conditions are satisfied, then deduction shall be allowed as 100% of all revenue and capital expenditure. All revenue except land and building. What they're saying, except land and building. Earlier under section number 35, they were said that except land, but under section number 35A, 35 to AB, they said land and building, except land and building. But listen to me very carefully. When you will do harmonious construction, see what I have said, that if there is a section 35, okay, there is a part 35 to AB, and it is also a section number 35. So there is a section number 35 1 2, so means section number 35 to AB, section number 35 to AB is to be read in conjunction with all these section number 35, all the parts of section number 35, all the subsections of section 35 to be read in conjunction. And if you read, if you do what, harmonious construction, do you recalling the basic concept lecture? Harmonious construction, if you do the harmonious construction na, then you'll get to know that, then you'll get to know the land deduction will not be allowed, because it is not even allowed in section number 35 above, and not in 35 to AB. Okay, it is not allowed. Building, built-in deduction was allowed in section number 35, but section number 35 to AB, that is a biotechnology business, is saying that except land and building. But 100% deduction shall be allowed as per section number 35.14. That is this section number 35.14 is saying the capital expenditure is allowed 100% of all capital expenditure except the land. If you do what, harmonious construction, then the building is also allowed. Then there is a question in the ICA study material where they said that it is a biotechnology business. Then also they have taken the deduction of the building. Why they have taken the deduction? Because they have done the harmonious construction, and based on that section number 35.14, they can take the deduction of building. So I have done the summary of that only, based on that particular question, because you should not be confused in that question. Okay, now whatever the other revenue and the capital expenditure, you can take the 100% deduction. So land is not allowed, but building, where it is written that building will not be allowed, but due to harmonious construction of section number 35, we will read each and every section along with each other, and we will say that yes, 100% of the deduction shall be allowed for the building as well. Now, but there is a catch. Here the assessee should be company only. Other individuals shall not be allowed. Here the individuals can be also be done. Okay, if I am contributing, I in the individual capacity is contributing to any of these notified authorities. Okay, national laboratories, anywhere it is notified, I am doing my normal individual capacity, I was allowed 100% deduction. But for the biodiversity business, assessee should be a company. Here the contribution is not there. Here the contributions are not made. Here the business should be a biotechnology business. Here the contribution. eh, See, under section number 35, if you contribute as well, now you'll get the deduction. Here the contribution is not there. Here the business, the assessee should be a company and who is engaged in a biotechnology business. Understood? Now the company engaged in manufacturing and biotechnology business. The first condition is what? The company, the assessee should be company, and the company must be engaging in manufacturing and biotechnology business, and it should be approved by a prescribed authority. Then these deductions shall be allowed to you. Land, there will be no deduction. For building, you'll get the 100% deduction, but under section number 35.14. And for the other revenue or capital expenditure, you'll get the 100% of the deduction. So I hope this is here. We'll keep the session closed here as only. We'll start studying from section number 41.3 from tomorrow. So this is all for the day. I hope you enjoyed the session. I hope you learned a lot many things, how to interlink all those things, and how it is very easy if you remember, if you go in a flow. Okay, with the examples, with the all kind of a things, it is very much easy. That this chapter is very easy, and most of the things now, this chapter is very lengthy, but most of the things is very easy. The most of the things are like not very much important for the exam perspective. So if you just read it once, ignore it. This is what easy way to recall and remember the whole PGP chapter. So this is all for the day. We'll meet tomorrow, and by tomorrow we are trying to cover maximum part, and then the small part which is mostly known to you. If you do not know, do not worry. We'll keep from the very scratch. Okay, the sessions will be very is from the very basics, so do not need to worry. It is going to be your exam oriented batch. Very basics from the very basics. I will assume that you do not know anything. Okay, but just promise me one thing, that you need to write each and everything. You'll write each and everything in your copies, solve it, solve the questions whenever I'll say. Okay, revise each and everything daily. These all things will make a small changes in you, and by that you are going to get the exemption very easily. Okay, the DT, which is a nightmare for the students, will be a cakewalk for you if you follow all these steps that I am saying to you. All the very best. Let's meet in the next class. Okay, till then, take care and keep revising.